Welcome on my YouTube channel Equityverse. Today I have to analyze Dr. Reddy's Laboratories Limited, India's next generation global pharmaceutical leader. Dr. Reddy's Laboratories from generic giant to global innovator. Dr. Reddy's Laboratories is a very famous company in India and abroad. Sorry. Innovation driven growth and resilient profitability position Dr. Reddy as India's next generation global pharmaceutical leader. Dr. Reddy Laboratory has evolved from a traditional generics manufacturing into a diversified innovation-led global pharma company. With a strong growth in biosimilars, differentiated products and branded formulations, the company is well placed to navigate global pricing pressures in generics. Financial 25 and first quarter financial 26 results highlight steady top line growth, more than 11% year on year, and resilient EBITDA margin 26%, despite headwinds in US generics. At the current market price rupees 1200, the stock trades at a trailing 12 months price earnings of 17.6, below the sector's long term average of 20x. Dr. Reddy Laboratories has started from a traditional generic manufacturer, but by effort and tried effort with a great enthusiastic and well managed the company. It's a management group led global pharma company turned into global pharma company. It's a strong growth, biosimilars, differentiated products and branded formulation. Company's overview. Founded in 1984, Dr. Reddy Laboratories Limited is founded in 1998 and its headquarters is Hyderabad. And now it operates in 60 countries, offering its products, generics and APIs, biosimilars and specialty products, proprietary formulation and OTC, India branded generics and emerging markets portfolio. It has 21 manufacturing facilities and 5 research centers with over 1000 plus filings globally. Now its looks at glance financial performance, all values in crore except EPS and percentages. Metrics: sales growth, EBITDA, operating profits, EBITDA margin, percentage profit before tax, PBT, interest, EBIT, PAT, EPS, equity, year-end equity cap plus reserves, average equity for ROE, return on equity, capital implied, year-end equity plus borrowing, average capital implied for return on capital implied, return on capital implied, and dividend payout. The data is taken financial year 2022-21 to 2024 to 25, and it is also projected for 25-26. It is expected. So this data will be analyzed in next slide. So I will discuss there. So you see this table at a glance. Sales 17,517 crore to 28,011. Expected 38,032. Sales growth in 2022 8.74% to 13.54% in 25, and expected 35.82%. EBITDA operating profit 3,874 to 8,547 and expected 9,889. EBITDA margin 22.12% to 30.52% and expected 26%. Profit before tax 2,884 to 7,680 in 25, estimated 8,172. Interest EBIT 298127963, estimated 8492, PAT 1952 crore to 5655 crore, estimated 6846, earning price per share 23.47 in 21 and in 25 67.77 and estimated 82.05. And equity year end equity cap plus reserves 17,641 to 33,549, 39,575 projected. Average equity, return on equity 11.75% to 18.30%, estimated 18.73%. Average company implied for ROC 19,644 to 32,576 and projected in 26 40,490. Now dividend payout, the ROCE 15.18% to 24.4% and expected 20.97%. Dividend payout 21% to 12.12% and expected also 20% 26. Now the data table will be analyzed as given here. Revenue sales trend steady recovery since financial year 20 with double digit growth in 22 to 25. What it means, company had accelerated sales after COVID impacts. Geographic and product mix expansion. Europe biosimilar branded markets is visible in the numbers. A strong financial 25-26 estimated shows robust demand or one-time product mix to tailwind confirmed with management commentary. And now EBITDA and EBITDA margin percent. Trend margin improved markedly from 20% in 2021 to 30% in 23 to 25. What is meaning? Higher margins reflect favorable product mix, higher value launches, operating leverage and possibly one-time benefits. Margins can be lumpy in pharma product pricing in US generics, one-off other income. So watch sustainability in pharma margin is conservative is at 26%. PAT and EPS. 10. PAT and EPS rose sharply. EPS doubled financial 22-23 and remained high in 24-25. It means earnings recovery is strong. However, big EPS jumps in pharma can be driven by a few high value products or one-offs. Monitor quarter to quarter US sales product concentration on exceptional items. Now move to return on equity trend. ROC compressed during 2021 due to lower earnings and then rebounded to greater than 21% in 22 and to 24. FI financially 25 dipped to 18% as equity base grew. Strong reserves and PAT growth normalized. It means the company generates attractive returns on equity above many peers in years of a strong execution. A re-rating toward higher multiples is plausible if return on equity is sustained greater than 18% with growth. Return on capital implied. Trend is ROCE improved dramatically in 22 to 24, mid 20%, reflecting higher EBIT and efficient capital use. In financial 25, slightly lower but a strong 24.5. Financial 26 expected projected 21% because assumed higher capital implied. It means higher ROC shows capital efficient business, great for long-term value creation. Watch capital expenditure, working capital borrowings rose in financial 25, September 25. because rising capital employed without commensurate EBIT lift will reduce return on capital employed. Now dividend payout. Historically, its trend is historically variable 15 to 26%. Company paid lower percentage in financial 24-25 is 12%, only 12%. It means management appears to be retaining more earnings for growth, R&D purpose, balance sheet stagnating, consistent with a company investing in high value biosimilars and specialty. Dividend yield may be modest, but capital is being redeployed for growth. Now we look key ratios. Here sales, EBITDA, PAT, EPS, price earning, enterprise value by EBITDA, price to book value, gross margin, EBITDA margin, debt equity ratio, R&D, percent of sales is assumed. In 2021 sales this, now this, EBITDA this, 25 this, PAT 1952 in 21, now 5655 in 25, and it is expected 684 and EBIT also expected 962 and sales 37,000 crore. EPS 23.47 in 25, 67.77 and 82.02 in expected 26. Price earnings ratio 49.3 to 70.7, it is reducing trend. It also reduced in 25-26, it is expected. EBITDA enterprise valued by EBITDA 25.9x, it is also reducing 11.7 and 10.8, it is expected. Price to book value 5.68, it is also reducing, trend is reducing 2.99 in 25 and 26, 2.51. Gross margin 60.7%, it is upper and lower, again upper increases, again lowering, and it is expected 69.45%. EBIT margin 22.12%, here in 25, 30.52%, 26% in 26 expected. Debt equity ratio very lower. It seems Reddy Laboratories using low debt. It is equity based company. 0.125, 0.158, 0.148, here 0.048, 0.06, and it is expected 0.146. R&D percent of sales, it is 6.5%, 6.8%, 7%, 7.2%, 7.5%, it is expected 7.5%. Now it will be interpreted as price earning ratio trend. Financial 20 very high 49, compressing to 18 in financial 24, 17.7 in it is 25, and project 13.7 in 26 expected under improved earnings. Interpretation of this early high price earnings reflects depressed EPS in 21 post-COVID transition, while the decline through 22-25 shows EPS recovery and the market is starting to price and stronger earnings. The 26 projected lower price earnings assumes earnings catch up, and at constant price the price earnings naturally falls. If stock re-rates upward with earnings, price earnings could stay stable or expand. Enterprise value to EBITDA trend is very high 26 in financial 21-22, when EBITDA was lower, improves to 11.7 in financial 25 and 10.8 in financial year 26, it is expected. Interpretation EV by EBITDA is a cleaner enterprise multiple, takes debt to cash into account. The steady decline implies improving operating profitability, EBITDA rising, and a healthier EV net cash position. Financial 23-25. In 2026, it is expected improvement to 11 signals better operating leverage if EITD growth holds. Price to book value trend is very elevated in 2022, 5.7, 5.2 and 4.3, then moderating to 33.55 financial 25 and 2.99 in 2025, and in 26 it is expected 2.51. Interpretation: price book value decline mainly reflects strong reserve build up, book value growth, and a stable share price. Higher book value from retained earnings dilutes PYV ratio even while the company retains shareholders value. Lower PV ratio can make valuation look cheaper even if market cap is steady. Now move to gross margin. Trend is 60-60% historically. Financial year 22-23 spikes 64-65 likely due to product mix and favorable gross profits. Financial 24-24 63-62%. Interpretation is healthy gross margin 60% plus, so strong product economics. Pharma companies typically have high gross margin. Net of raw materials mix shifts, specialty biosimilars versus commodity generics drive these levels. EBITDA margins percentage trend ranged from 22% financial year 2021 and 19.8 in financial 22, jumped to 30% in financial year 23-24 and 30.5% in 25 in financial 25, assumed 26% in 26. More conservative interpretation is large swings reflect one-time items, product mix changes, and operating leverage. The very high margin in financial year 23-24 indicate a favorable mix. Other income operation improvements for financial 26 used a conservative margin to account for any investment in R&D and higher A&P or one-off cost. If the company sustains 30% margins, valuation dynamics improve further. Now debt to equity ratio trend is low throughout, less than 0.16, dip to very low 0.048 in financial 24 and slight increase in financial year 25 0.06 and then projected to 0.146 in financial year 26 if borrowings rise as per September 2025 numbers. Interpretation: companies very lightly leveraged historically, often net cash. A rise in borrowings September 2025 could be funding capital expenditure, working capital, but on the book basis the company remains conservatively financed. Research and development percentage of sales assumed trend rising from 6.5 to 7.55 in 24-25 year financial year and maintain in financial 26. It is expected. Under interpretation, high R&D percent signals focus on long-term pipeline biosimilars specialty. This is positive for value creation but can press short-term margins. Markets typically reward successful approvals and first-to-market wins. Now, segmental highlights. Quarter segment share of revenue year-on-year growth remarks. US generics segment. In US generics share revenue 40%, very high. Year-on-year growth 2%, -2%, but a declining trend. Remarks: pricing pressure, new launches to offset. Indian formulations 19% revenue, year-on-year growth 12%, more than 12%. A strong domestic momentum. Europe emerging market 26% and plus 18% year-on-year growth. Expanding footprint. Biosimilars and specialty 15% share revenue and year-on-year growth plus 25%. Fastest growing segment. Investment thesis. Biosimilar led growth. Key points: expanding pipeline of biosimilars in oncology and autoimmune therapy areas offers long-term high margin opportunities. US recovery, new product launches and a diversified pipeline to offset price erosion. Margin stability, strategic cost optimization, higher contribution from complex generics and backward integration support EBITDA margins. Digital and R&D transformation. Focused digital analytics and AI-driven discovery enhance pipeline efficiency. Strong balance sheet. Minimal debt and strong cash reserve enable merger and acquisition and global expansion. Now valuation. Valuation approach is price earnings ratio and enterprise to EBITDA on enterprise value to EBITDA basis. It is expected in 26 EBITDA 9620 crore. Target multiple 8.9 10.8. Enterprise values of 1,03,896 crore. Fair value per share is rupees 1250. Conclusion: both here is also in EPS financial 25 and 60 EPS is 16.77 and in financial year expected 87.34. Target price is 70.7 and 13.7. Target price earnings 70.7 and 13.7 in 26 expected. Then target price at 1,250. Current market price is 1,200. Then upside potential 5%. Both P and EBITDA methods converge near rupees 1200 to 1250, confirming a buy with medium term re-rating potential. My YouTube channel Equity Verse does not provide financial advice on any equity, any share. So please you consult your financial advisor and financial analyst for this. This channel is only for educational purpose. Short analysis. What are the strength? Diversified global portfolio. US, EU, India high dependency on US generic revenue. A strong R&D. Strengths are diversified global portfolio. US, European, India. Strong R&D and biosimilar pipelines. Robust balance sheet, low leverage, trusted brand and global regulatory credibility. What are the weakness? High dependency on US generics revenue, margin volatility due to product mix, currency fluctuation exposure, slower specialty modernization. Now pester analysis. Factor: political supportive Indian pharma policies trade-off risk in US. Economic inflation may pressure input cost, global demand steady. Social: aging population drive drug demand, brand trust critical. Technological: AI, digital R&D and automation improve speed to market. Environmental: ESG compliance and sustainable manufacturing key for European markets. Legal and regulatory: strict FDA and EMA oversight, continuous vigilance needed. Now, Porter's 5 forces analysis. Force: competitive rivalry, impact high, very high. Intense competition among generic players like Teva, Sun, Cipla. Threats of new entrants, moderate. Due to high capital and regulatory barriers, limit new entrants. Bargaining power of buyers. Impact high. PBMS and large distributors drive pricing in US. Bargaining power suppliers. Impact low, moderate. Backward integration reduces dependence. Threats of substitutes, moderate. New therapies and biologic could erode demand for existing drugs. Now, peer comparison. His net debt companies name: Sun Pharma, Divi's Lab, Torrent Pharma, Cipla, Jadis Life, Mankind Pharma, and here Dr. Reddy. Net debt, a market price, market capitalization by net price, net profit, price to book value, EV by sales, EV by EBITDA. These are table. Now it is analyzed in next slide. Valuation. Dr. Reddy Laboratories looks cheap. Dr. Reddy's price earnings 17.7 and EV by EBITDA 7.7 are among the lowest in this peer group, despite ROC 24.45%, which is similar to high quality peers, Cipla, Divi and Sun. That signals possible valuation gap versus peers with comparable underlying returns. Quality of returns. Dr. Reddy Laboratories ROC 24.4% is strong. In the same ballpark as Cipla 22.7% and DB 20.4%, implying efficient capital use. Balancing DRL carries moderate net debt 3,394 crore. It is not net cash like Sun, Divi, Cipla are, but net debt is small relative to market cap, 3.3% of market cap. So leverage is manageable. Price to book value. Dr. Reddy Lab is price to book value 2.99 is below many peers like Torrent, Sun, Mankind, Divi. Again a relative value point. Enterprise value versus sales. DRL has the lowest EV by sales 3.11 amongst most listed peers, suggesting the market value is ₹1 of DRL revenue less than peers. Premium peers versus discount names, specialty pure play quality names. DV's Torrent trade at very high multiples, EV by EBITDA 33 to 46, price earnings 60 to 70, reflecting higher growth. Margin profiles DRL sits in the value for quality quadrant, good ROC but modest multiples. Now its interpretation is net debt cash. DRL Dr. Reddy Laboratories 3,394 crore net debt. A small relative to market cap, net cash peers Sun, DV and Cipla have balance sheet optionality for buyback and merger and acquisition. DRL's recent higher borrowings in September 25 suggests funding capital expenditure, working capital or investments manageable but vast trends. Price earning ratio DRL 70.7 is reasonable given EPS power industry cyclicality. Higher PO in DVs and Torrent shows the market pays a premium for specialty defensible margins. Lower price earning suggests re-rating runway if execution improves. Price book value DRL 2.99 lower than many peers, Torrent 15, Divis 11, reflecting either lower sentiment, re-earnings quality or relative value opportunities. Price book value compresses as book value grows retained earnings. EV by sales DRL 3.11 lowest among listed peers, indicates market value to its revenue more cheaply, good for investors if revenue quality improves and margin sustains. EBITDA DRL 11.7 versus peers Cipla 40.9, Jades 12.8, Sun 22 and Divis 46.3 lower. EBITDA means cheaper on an operational multiple either due to lower expected growth or risk discount. If DRL reduces execution risk, multiple expansion is possible. Return on capital employed DRL have 24.45%, robust and comparable to Cipla 22.7% and above DV 20.4% and Sun 20.2%. High ROC supports higher valuation. The market currently undervalues these attributes for DRL versus some peers. Investment, cash equivalents and financial investments. DRL investment is 4,701 crore. Healthy peers like Sun show high investment 19,543 crore, reflecting different cash management strategy. Now strength weakness versus peers. Dr. Reddy's relative strength. Strong ROC 24.45% demonstrating capital efficiency. Lower EVI, EBITDA and EV sales give an attractive margin of safety versus peers. Diversified revenue base US, Europe, India and biosimilars. Not shown in peer table but an important qualitative advantage. Reasonable level of investments for growth. Pipeline, Reddy's relative weakness, risks, net debt versus net cash peers, limits immediate financial optionality. Lower multiples suggest either market skepticism about sustainability of margins, earnings or product pipeline risk, US pricing, regulatory. Investment needs R&D, capex may keep returns volatile in short term. What are risk factors for Dr. Reddy Lab? US risk FDA observation, products recalls, US generics pricing erosion, delayed biosimilar approvals, currency fluctuations affecting export profitability, R&D execution delays. Now analyst recommendation is the parameter value, so current market price 1200, target price 1250, upside potential is 5%, investment horizon 12 to 18%, 18 months. Recommendation buy or accumulate. Risk level moderate, sector and regulatory. My YouTube channel Equityverse does not recommend for any buy, hold and sell purpose, sell recommendation advice. So you consult for this your financial analyst and financial advisor. My YouTube channel is only for educational purpose. Now conclusion. It conclude Dr. Reddy Lab is entering its next growth phase, balancing defensive generics with high value biosimilars or specialty products. The strong fundamentals and diversified portfolio on digital driven R&D make it one of the most resilient Indian pharma plays. We maintain a with 12 months target of rupees 1,250, implying a 5% upside potential from current market price 1200. Again, as I am saying, my YouTube channel does not recommend buy, sell and hold advice because my YouTube channel only for educational purpose. Thanks for watching. We will meet next video. Again, goodbye. If you this content you like, then you subscribe my channel, like and press bell button so that my upload video could reach to you as soon as possible.